parts of the FICO score, right? Everybody wants to know what they could do to, raise their credit, improve their credit, make a change to their credit. But I think it's good if we start off with a fundamental understanding of the basics, right? So let's just kind of, over the next few sessions that we do, we're going to talk about the different parts of the FICO score. And then if you have questions, you can either ask them at the end or DM us, and we'll certainly, get back to you with an answer. So that being said, let's talk about the biggest part of the FICO score, and that is going to be payment history. Payment history itself counts for 35% of your FICO score. So that's 35%. So if that doesn't sound like a lot, I want you to think about it like this. Back when I was in school, if I took a test and I missed 35 points off of it, that puts me at a D. Like, so if we took 35%, of 65 was a D back when I was in school, right? So then that means that if everything else is perfect on my credit, but my payment history is jacked up, the highest grade I could get, so to speak, would be a D. A D is better than an F, but you still aren't getting into college. So, in order to get our credit the way we want it, let's understand the biggest part of the payment history. Now, it sounds pretty straightforward. Pay your bills on time and you'll be okay. But there's a little more to that. Let's talk about what your credit report looks like. I'm surprised that the number of people that we talk to that have never actually looked at a credit report, right? So when we talk about payment history, what does it look like when you pull your credit? There is going to be a chart that's based on month and year. So you'll see January, February, March, all the way to December for 2020, and then 2021 and the following year, right? Payment histories will typically report as much as 10 years on a standard account. Now, there are other times when it would report more. We could talk about that in a minute. But basically, the biggest takeaway on payment history is that your creditors report on 30-day intervals, right? So when we say never be late on a bill, nobody's perfect. We're all human. Things happen. You could actually be a couple of days late. Heck, you could be a couple of weeks late. But what you really want to avoid is being 30 days late on your credit. To illustrate that point, you could be 29 days late on every one of your bills that reports to your credit and still have a perfect payment history because it's not going to hit until that 30th day. Now, I know somebody out there is like going to take that information and run the wrong way with it. So I'm not advising you to be 29 days late on a bill. You're going to upset your creditor. But in the event that you are late, you forget a bill, or maybe your due date didn't line up with your paycheck, I don't want you to lose sleep over that. Just make sure you get that in as quickly as possible. Now, we are in a tough time. The economy is rough, and it's going to be challenging, unfortunately, on some people more than others. And if you're going through a tough period, I would just implore you to do whatever you can. Uber, Lyft, DoorDash, do whatever you can to make sure that you don't hit that 30-day mark. Because once you get out of this temporary storm, you don't want to suffer, for the consequences of a temporary situation, right? Now, if you're just in a situation where you're doing the best that you can, and you're already past the 30-day mark, again, just, stay focused. The next thing you want to avoid is a 60-day mark, right? So then just try to get your account caught up by that 59th day, to avoid any issues, right? So now let's talk about something I mentioned earlier. I said accounts can stay on your credit report for up to 10 years. So let's talk about payment history and how different types of accounts affect it. You have two types of accounts. One would be open, right? As it implies, it has no end to it. It is open. As long as the account's active, you will have an open account. You can have an account open for as long as you live, right? And then you're probably going to see where this is going. You have closed accounts, right? So an example of a closed account would be an auto loan where you go to your creditor, they're going to tell you what you pay, the date you pay it, and how many months you pay it. That has an end to it. You know right here from the time you drive off the lot, if you at least were paying attention, and not taking pictures of your new ride, posting it on the gram. But if you're paying attention, you know that your last payment is going to be, I don't know, August 2029, hopefully, if you finance for 6 years, right? So that's a closed-end loan. An open-end loan would be like a credit card, right? You're only going to have a bill if you use the card.
Yeah.
And because of that, it's just going to stay open as long as you're within good standing with your credit. You want to have open accounts because the longer the account is open, the longer you benefit from the payment history you've established, right? So what happens when you make the last payment on a closed account? Well, the clock starts ticking. So my last payment on my car was this month. Two things are going to happen. One, let's talk about one credit myth now, is that a lot of times when people make that last payment on an auto loan or a personal loan, they expect their score to go up. In most cases, your score, nothing's going to happen to it. In fact, you're more likely to lose a few points than you are to gain a few points. Why? Because your payment history, again, 35% of your score needs to see activity to benefit. And you're not going to see any more activity once an account closes, right? So that's why you want to make sure you have some credit cards. I talk to people all the time, that don't want credit cards. They think it's Satan's plastic and they're just going to get themselves in trouble. I've never seen a credit card take itself out of a wallet and charge itself. I've never seen a Visa card swipe itself, right? So, you need to have plastic, right? Because what happens is that I've talked to people in their 60s or 70s that have no credit at all. They want to buy a house, an RV to travel, knock that bucket list out, or maybe they want to help a grandchild or something like that, right? And then they go to get a loan and they don't have any credit, right? And they use language like, I'm going to go down to the Wells Fargo and talk to my banker. Like, nobody calls tellers bankers anymore, right? Anyway, so they go there and they're like, hey, we have no credit. And then your granddad's upset because he's like, I financed 15 cars with you. Well, the problem is, even though he's probably made, on-time payments and is super responsible, remember, closed loan, right? Closed-end loan. Once he makes that last payment, the clock starts ticking. And a closed account in good standing will be on your credit report for up to 10 years, right? Now, on the flip side, how long is a negative closed account on your credit? Up to 7 years, right? So there's a lot of people out here that, because they don't want to, they're scared of credit cards, they get these auto loans, and they have had credit all their life and they've paid off these loans, but because they were all closed-ended, they don't have any credit to show for it. All that good history eventually disappeared, right? So now, cool thing though, we're doing this with a loan officer, Leah the loan slayer, right? If you're Leah Jones, if you're jonesing for a mortgage, go to Leah to get your fix. You see how I play with that name right there? Okay. So the thing about a mortgage loan is that typically a lot of people will finance for up to 30 years. That's 360 months, right? Now, that is a closed-ended loan. A mortgage is a closed-ended loan, but because you're financing it for 30 years, I mean, most people aren't going to see the end of it, and it's just the type of loan that benefits you. And in fact, the FICO scoring model actually emphasizes a mortgage trade line on the credit report. You will get benefits from a mortgage loan. They are looking for that. The FICO scoring system likes to see a mortgage on somebody's credit report. But 35% of your credit report is the payment history. So what you really want to do is make sure you have a credit card, right? Now you need to make sure it stays open. Staying in good standing is more than just making your payments on time. You know,
Yes.
you actually have to use the card, right? And as such, you know, you want to use the card at least twice a year.
Yeah.
You know, if you don't, that open-ended loan could get closed by the creditor. I also see a lot of people, you know, they're wondering why their credit scores are 500. They swear they've had this, you know, credit card for, you know, years.
Yeah.
I opened this card years ago and I was never late. Well, okay, when was the last time you used that card? Oh, well, I don't remember. And then, you know, we pulled the credit report and sure enough, it says, you know, account closed by credit grantor. You know, these lenders are giving you cards um, to make money off of you. They make money with interest. And you know, when you loan people money, it's a risk, and you know, it's they're not benefiting from the risk if they just let you walk around with plastic in your pocket and you're
Yeah.
not swiping. So make sure you use the card, you know, at least once a year. I personally have a spreadsheet, and I make it a point to use my credit cards every 3 months. So.
Okay. I like that. I like that. That's definitely some good feedback for sure. I think a lot of times when it comes to credit cards, people forget about that. Like they understand that they need to have the purchasing power, but they don't always think about, oh, I actually need to use this. Because I have people all the time too that I'll pull up their report, you know, they're getting their mortgage, and believe it or not, I've actually had one that they had really good stuff on their credit report. You know, things were paid on time, but they had just opened this particular revolving or credit line. And because it wasn't actively used, I actually couldn't use it as a trade line to help them get the specific loan that we were looking at. So we had to switch gears to a different type of loan. But when you're thinking about credit, and you're thinking about how does my payment history affect it, how does the type of credit close or open ended, if you plan on buying a house anytime soon, this is definitely something you want to talk about with a loan officer too, is, you know, how is these things also going to affect my ability to get a loan? So really, really great stuff. You know, the payment history, 35% is a lot.
It
It is
is.
a lot. And for
So
anyone
can
who's
we
like,
stop right
oh, but
there?
yeah, yeah,
Can we really drill down on how impactful 35%
yeah,
of 100% is? Because I try to use, you know, what a D looked like when I was in school, but nowadays, I mean, you know, I understand, you know, they just keep passing kids from grade to grade. So that example might not really hit, but I mean, you know, and then, you know, when you're looking for a sale, you know, and you walk into the store, you see 35% off, you know,
yeah,
most people don't get excited. You want to see like 80% off, bro.
yeah.
35% off is a
A
lot.
lot.
35% of your credit report is everything. So I just want to emphasize that, guys, this is actually the biggest slice. If you were to look at a pie chart of the factors of credit, your
Mhm.
payment history is going to be the biggest slicer. So please don't take it for granted. And, you know, I did touch on, you know, a good standing, right? Or showing activity. Showing activity is actually using the card, but to take it a step further, you should leave a small balance on your credit report, right? So
Yeah.
on that particular account. So, you know, if you have a, you know, if you have $1,000 limit, you could leave as little as, you know, $10 to $70 on the credit report. That should put you in about a 70% range of utilization.
Okay.
And that would be a sweet spot to give you activity. You can't build history without activity,
Yeah,
right?
absolutely. Absolutely. No, I love that. That is a big thing. And so when you think about, because you know, I'm a mortgage girl, so I'm going to tie everything to mortgage. But when you think about your payment history on the mortgage side, one of the most important things is I asked this question during a consultation. Have you ever been late on a loan in the last 12 months? This question is very important during the consultation because before we pull credit, before you even do an application with me, I want to know if you're aware if you have ever been late in the last 12 months. That's important because believe it or not, being late 1 to 2 times on an auto loan, especially, or any loan, and especially if you have a mortgage, Definitely. But being late 1 to 2 times in the last 12 months can actually disqualify you from getting a mortgage, depending on the program. Some programs will allow one late within the last 12 months. Some will allow two, depending on how good your credit score is. But again, late payments are not, they do look at them very seriously when you're looking at getting a mortgage. So just be very careful, you guys, with these late payments. We're human. Things happen all the time, so the fact that you have some grace period is really important to know. That's a really good tool for somebody who may just need it, to know that, hey, you could make a payment in 28 days instead of on your due date if you need an extra room. So I love that. Those some really good nuggets, Dwayne. Really, really good nuggets
Well,
there.
I wanted to share that because, sometimes, if you're struggling and you're just frustrated, a lot of times with frustration comes a lack of focus because you just feel overwhelmed in life. And I mean, you might say, hey, I'm already late, who cares? But no, you're like 18 days late. You still have time, to make that happen. And the other thing, you brought up an excellent point, about, 1 to 2 late payments in the last 12 months. I mean, guys, your payment history, we're talking about how to leverage it to your advantage, but it's there for lenders to make a judgment call, to loan you money. I mean, and let's kind of, if Leah allows me to, let's for a second, let's not say we're buying a house. Let's rephrase that. Let's say, because what's the average home price out there for you?
Here in Florida, Bay County specifically, we're looking at anywhere probably around, I'd say 350 right now.
Okay, 350. Okay, cool. So let's instead of saying I'm going to buy a house, let's say it like this so you understand the impact of payment history. Let's say I'm going to borrow $1/3 million in cash and I'm going to have a house for collateral. Like that just sounds different. Like buying a house, and that is what you're doing. You're buying a house, but I want you to imagine somebody putting $350,000 away in your name cash, right? Now, look at it from their perspective because sometimes as consumers, we're looking at it from our perspective.
Yeah.
Look at it from a creditor's perspective, right? You're about to borrow $1/3 million, and then they look at your credit report, and not even 12 months ago, you went 30 days late on a $25 minimum payment.
Hmm.
Like that doesn't necessarily give a creditor the confidence to loan you money. If your cousin asks you, hey, can I borrow, $100? And then you talk to your sister and find out that same cousin owes her $50, and every time she calls about it, he on some, oh, I was just about to call you.
Hmm.
Does that make you feel good about giving him even more money than what he's already delinquent on? So, like think about it like that. You wouldn't want to loan money to somebody who was past due on a smaller amount than they're asking you for. So it is a very big deal. Make sure you get those payments in on time. And again, I've just seen so many people overwhelmed with a lot going on. You're a mom, you're a parent, you have your job, you're a sister, you have all these hats that you have to put on. And sometimes people sacrifice themselves in the name of trying to show up well for other people. But you got to be there for yourself first in order for you to be there for, other folks. So please, I cannot emphasize the importance of making sure you avoid that 30-day mark as best you can. Right.
Absolutely. I love it. I love it. So, look, you gave us some really great stuff on payment. I know you had wanted to touch on a few other things regarding, understanding the fraudulent side of things and fraudulent accounts going on your credit score. So, talk to me a little bit about that. How does that impact the credit score whenever there's any fraudulent accounts that come up?
Well, I was just playing with the score simulator right here, and I was playing with my score, and there's a box I could check where it says, "Hey, forget to pay a bill," and it looks like my 807 TransUnion score drops down to a 732 if I forget to pay one bill. So that's about a 75
Wow.
point jump. And in some situations, it's worse. I've seen it people lose 150 points on one late payment. So what does that have to do with fraudulent accounts? The thing about a fraudulent account is that, if it was on your credit with a poor payment history, not only would you still lose the same 75 points, but it ain't even yours, right? So it's just a slap in the face, right? Even if it was a positive fraudulent account, right? If it didn't belong to you, that can affect other parts of your score, right? And then if you don't know who's the account really belonged to, how it ended up on your credit report. I mean, again, late payments can start popping up. How do you know another account's not going to pop up? So a fraudulent account could certainly impact you for a number of reasons, but just focus on a payment history. I've seen fraudulent accounts where people say, hey, this doesn't belong to me. I've seen situations where, maybe somebody gets a $5,000 loan, for instance, and then they never make any payments on it. Then it goes to collections, then it's in your credit report, right? So, but I want to say that fraud, since you brought it up, I just want to touch on a couple of things. Fraud is not necessarily, I don't know, somebody with the little bandit thing over their eyes, looking like a Hamburglar, break it into your social security and bank accounts, right? Sometimes a fraudulent account could be as simple as an error where they're entering your information. I've seen people get mixed up with somebody off of a number being off on a date of birth or a social or even an address, right? So that's why you should be checking your credit regularly. Free apps are good enough to do that. To make sure that everything that you are familiar with is on your credit report and nothing that you aren't isn't on there, right?
Absolutely. I love
Yeah,
that.
yeah. I have a question for you, actually. So when we talk about fraudulent accounts, because I'm assuming a lot of people that would tune in are interested in getting a house. How do fraudulent accounts affect the loan approval process? A lot of times when you're buying a house, especially if you picked out a property with the agent, it's a competitive marketplace. How can a fraudulent account affect somebody's ability to compete in this housing market?
Yeah, absolutely. So, there's a lot of things that are going to go into it, but to keep the long story short, the biggest thing is to understand that whenever a fraudulent account is on the credit report, so if when I review these with my client, if they tell me, hey, that's not mine, or they know that they're actively working on something, a lot of it's going to come down to what type of account it is, what the status of that account is, and how it's essentially affecting this. So is it something that is just maybe an open account where there's been no activity on it? Okay, it's not affecting your debt to income, things like that. Then we may not have a problem with it affecting your loan approval while you work on getting it removed from your credit report. Versus, and I have actually had this happen in real life where a loan was actually open in a client's name that was in process of trying to get a home, and they had worked with a number of other lenders to try to still get their home while they figured out this loan issue. And fortunately, they were able to, make it work and do what they had to do with that particular loan. Even though it was fraudulent, they were able to take care of what they needed to take care of, and we were able to close their loan. The problem was they got hit with their credit report and they got hit on their credit score. So the credit score went from what other lenders were willing to accept to one where a lot of lenders were not willing to accept. We allowed it. We still were able to close them at the lower credit score, fortunately, but they took a really big hit on something that wasn't even theirs.
Mm.
And so that, if it wasn't for our lender being able to help them, they would not have been able to close in their home. And they wouldn't have to do it until that item had been corrected on the credit report and showed a rescore of a better score. So I like to say it really just depends on what it is. The best thing that you can do in that situation, if you are trying to buy a home and you know or don't know, but it comes up as something is fraudulent on your credit report, is we review it together and
Right.
look at options, because sometimes there are guidelines in place that allow us to kind of move past it, and deal with the mortgage side of things while you deal with getting your credit side fixed. And then sometimes you have to get it fixed before we can do anything.
Right. Hey, but listen, for that success story right there, shout out to Buck Mortgage, right? You know what I'm saying? Get more bang for your buck at Buck
I
Mortgage.
like it. Yes. I'm about to use that on my
Use it. You can have it.
but I'm gonna tag you in that. I will be using that.
My gift to you, my friend. Here you go.
Thank you. Free marketing right there. I love it.
Anyway.
Oh man. Oh,
But
perfect.
so that's great information for fraudulent accounts. And again, I think the takeaway, what is the simple takeaway from all this great information? Keep an eye out on your credit report. Pay attention to the notifications, making sure you're looking at all three credit reports, right? And again, you can use any monitoring service to do that. You just want to make sure that you're looking at the information on the credit report, not necessarily the score that one of these apps provides.
Yeah.
So, but yeah, you want to know things. In all these scenarios, it seems like the common denominator is finding out about something at the last minute. It just seems like if we were keeping an eye out on our credit, some of these scenarios could be avoided, right? So, what was so a good thing you got the yes in that situation? You're able to save them because who knows what that rent renewal or scrambling to find a place would have looked like. I mean, probably very expensive, but what type of hit did they take on the interest rate they actually got versus the interest rate that they could have gotten if it wasn't for that, fraudulent account?
Man, that's a good question because yeah. So, I'll just say on the traditional rates, I mean, they probably would have seen, not paying any points to buy it down, anywhere from a half a point to a whole point in difference, from the score that they ended up being at to what they were prior to the issue.
Okay. And in layman's terms, on the average house of about 350, what does that look like in a monthly payment?
Oh man. So it kind of, so as far as monthly payment, I mean, you're looking at a difference of, maybe a couple $100 really. So you could in total payment.
Right.
So, including if you have mortgage insurance or private mortgage insurance on that as well. So you could be looking at a couple $100. You could be looking at anywhere from $100 to $300 in payment difference.
Y'all better start monitoring freaking credit report.
Get the Experian app or Credit Karma or something. Yeah. So no, it's definitely one of those where we were fortunate, and the client was pretty fortunate to be able to make that work. And fortunately, we had a couple things in place. So
Hey, look, while we're on the, guys, it's hard to stay on topic when we're talking about credit, but since you're talking about fraudulent accounts, I mean, the dark web and those hamburglar looking dudes, I mean, that's one source of possible fraud. Something as an identity mix up is another source to get that. But I'm gonna tell you the other source, be them people at your family reunion. If they still show up after they installed your identity. So y'all, I can't tell you how many times I get somebody, they call our company, they want some help with an account, it's complete fraud, and then the conversation goes into, well, hey, did you get a police report? No, because it's my son, or it's my cousin, or it's this, or it's that. So guys, just really, I don't know what to tell you about that. I know what I do if my cousin stole my identity. I know what I do, but
yeah, we have a problem.
Yeah,
And that was
yeah.
me.
Yeah, so guys, just think twice about how you help friends and family members, especially if you know you're about to make a major financial step in trying to do something big like, maybe start a business or buy a house. Maybe you don't help somebody until after you close or after you speak to the lender to discuss what the impact of that looks like. I mean, I can't tell you how many times, fraudulent or not, co-signing for somebody or helping somebody in a way that makes you vulnerable can adversely affect your payment history. Co-signing on somebody else's account can certainly affect your payment history. I just made a long post about that, and it got shared a couple times because a lot of times if you co-sign for, say, someone to get an auto loan, the creditor is not necessarily informing you when the payment's late.
Yeah.
I'll never forget, I spoke to a woman who got turned down by her lender. No lender could have helped her really. But I mean, here's a woman in her 60s that's paid every bill she's ever had on time. And she has a repossession on her credit. And She's like, I don't have a car. Well, it looks like you co-signed for, come to find she co-signed for her child who was in another state. And every time, she talked to her kid, it was like, oh, everything's fine, mom. Everything's fine, mom. And then it was anything but fine. So, guys, just make sure you don't co-sign for anybody. There are other ways to help family members and people that are important to you if you have good credit. Make sure you don't co-sign. Make sure you monitor your credit. Those would be the best steps you could take to protect yourself, right?
Yeah, absolutely.
Yeah,
Absolutely.
it's preventable.
Yeah, most definitely. Yeah, those repos make it very difficult
I
to
mean, it
get.
hurts when you ain't, a lot of times your cosign doesn't feel like you bought a
No,
car. Right.
it's not yours. Yeah.
Right.
But on there, you're liable. So
Yes.
I could talk about that all day, but no.
So one more thing about fraudulent accounts. So, I mean, okay, if somebody has fraudulent accounts and they're impacting the credit score, are there ways around that? I mean, would a higher interest rate help secure a loan? Can they just throw money at it, make a bigger down payment if they got a fraudulent account up there?
Yeah, so it definitely does go back a little bit to what I said earlier, and then we have to really look at the whole picture, because when we're trying to decipher whether a loan is going to be pre-approved or not, they look at everything, and that's why I always talk about not just about score, it's also about history, in addition to income and everything else. But they look at everything. So having more money to come to the table can offset your risk in terms of the credit side of things sometimes, depending on what that risk might be. So everything, when you think about like how a lender sees things, they look at everything as risk. And so income is a risk, down payment or lack of down payment or closing costs is a risk. Credit score obviously is a risk. Credit history is a risk. So if one area has a little less risk than the other, meaning you have more assets to bring to the transaction, whether it's for the down payment closing costs and something we call reserves, which just means extra money that you have available to you in order to cover the mortgage payment if you needed to. That's what reserves are. So that could help you in still getting a loan approved, if for whatever reason, by having whatever derogatory or fraudulent account on your card or on your account may be causing, maybe you can't max out, let's just say FHA at 55% debt to income ratio, maybe you can only go to 43%. So by having money for your down payment, you can do that by keeping your debt to income ratio under 43%. So there's ways we can kind of try to work the numbers to help a client and see if it'll help them mitigate and overcome a negative on their credit report.
Okay, cool. Nice. So any other points do we want to cover about payment history?
No, like you hit the nail on the head on all of it. I think the most important thing, like you said, was just understanding how much of your credit history or payment history affects your credit score. I think that is a key piece. And then also understanding how the payment history kind of works with your credit. I think those are really, really important pieces that people need to know.
So guys, just in summary, make sure you understand that credit reports in 30-day intervals to your credit report. Pay on time, but life happens. Avoid that 30-day interval. Get it in by the 29th day, the 59th day. Also, if it's day 29, don't mail the payment in. You need to
Yeah.
you see what I'm saying? I mean, right?
Yeah.
What's that meme on now? Where the guys
Yeah.
yeah. So
Don't do that.
right, make sure you get it in on that 29th day. Just understand that you have that leeway, and look at it as giving yourself a personal loan or a payday loan, right? So the other thing, guys, make sure you have open-ended accounts. Somebody may have given you advice and it may have meant well, say, hey, avoid credit, only apply for credit when you need it. Well, when you turn 18, you need it. And if you want to look good on paper to buy a house one day, you need to have an open-ended account. So go ahead and go out there, get a credit card, get more than one credit card, get a couple of credit cards. But just because you get a credit card doesn't mean you have to max it out. Make sure you use it at least once a year, twice a year. And you don't have to, if you got $1,000 credit limit, and I say use it at least once a year, that's not an excuse to go out and spend $1,000 on a shopping spree. You could go to the register, buy a pack of gum, and you're good. That counts as activity on your credit. And then leave a small balance on your credit card, $10 to $70.
Okay.
Right? You're good.
I love it. Great. I love this. I love this. I think this is great information that, we get questions about all the time, whether it's on the market side or just people just asking questions about credit in general. So I'm glad that you really dive deep into it with us today on this slice of the pie of the credit history and the cycle score and understanding that. So thank you so much, Dwayne. I love this. I love this. Can't wait for the next one.
Cool. All right. Now, every last Tuesday. Today's Tuesday.
Yeah, I know.
Yes.
I'm like, wait.
Yeah.
So, yeah. Anybody who's in Florida and possibly in the way of the storm, hopefully you guys are staying safe. And if you're supposed to evacuate, please evacuate. It's nothing like being stuck in a hurricane. So hopefully you guys are all safe for anybody that's watching this today and this week. And if you guys need anything, we'll be here on social media. Get in our DMs and we'll be happy to answer what you have. But again, thank you so much, Dwayne, and we'll see you next one.
Thank you. Follow me on Instagram, Financial Chocolate. Thank you.
Got it.
All right.
Bye.